Today, let's look at the Grinold Kroner model, which is used to forecast the expected return of equities. In this model, the return of the equity, for example a stock or a market, is the sum of three components, namely, the dividend yield, the percentage change in earnings per share, and the percentage change in price-to-earnings ratio. Now, let's compare the Grinold Kroner model to another model that we know very well, the Gordon Constant Growth Model. In Gordon's Constant Growth Model, the current fair price of a stock is a function of the dividend in the next period, the equity return R, and the constant growth rate G. If we rearrange the equation of Gordon's model, we see that the return of the equity R is the dividend yield in the next period plus the constant growth rate G. In comparison to the Gordon model, Grinold Kroner model also takes into account the effect of share repurchase on equity return. When stocks are repurchased, earnings per share increase because the number of shares outstanding decreases. So, if the capital letter S in the equation, which represents the number of shares outstanding, is a negative number, meaning that number of shares outstanding has decreased, then the total return on equity will increase. The third component of the Grinold Kroner model is the percentage change in price-to-earnings ratio. To smooth out fluctuations in earnings through the business cycle, we use the cyclically adjusted price-to-earnings ratio, which is the ratio of current equity price over the average earnings over the last 10 years. So now we know that Grinold Kroner model is a discounted cash flow approach to calculate the expected return of an equity. It is similar to the Gordon model, but adds more details such as the effect of repurchased shares on equity return. Another question we need to consider is how we forecast these variables in the equation in the long run. In the long run, we expect the percentage change in earnings to be equal to the nominal growth rate of the GDP. We expect the percentage change in shares outstanding to be at zero because a company cannot continually repurchase its own shares, as doing so will reduce shares outstanding to zero. We also expect the percentage change in price-to-earnings ratio to be at zero in the long run. Therefore, in the long run, the expected return of an equity is simply the dividend yield plus the nominal GDP growth rate. Thanks for watching this tutorial. If you have any questions, please let me know. Happy studies!